We all know that bull markets cannot last forever. Now, how long will the current one last? There are some fairly accurate valuation metrics that worked very well in the past. Let's have a look at them and let's see where we're currently at. Now have a look at this. This is the historical Shiller PE ratio chart. It's 150 years of data. It divides the price of the average traded stock by its earnings, and it tells us how much do we have to pay for the earnings. In other words, when the price is low relative to earnings, it's a very good time to buy. When the price is high relative to earnings, it's rather a good time to sell. What we've got over here is the Great Depression, which subsequently led to World War II. What we've got over here is the dot-com bubble burst. And what we've got over here is the global financial crisis. This is where Bitcoin got born. And so since Bitcoin's birth, it was all the way up. And we are again at historical highs, unfortunately. How often have we been at a Shiller PE ratio of above 37? Very, very rarely. And this chart does tell us the story that at some point this might turn around again. It's not necessarily great to be all in stocks, to be all in risk on assets. It seems like things are, historically speaking, quite heated. If you have started investing after the global financial crisis, if you're in the market for less than 14 years, you don't really know what it means when the markets completely crash. Now, not every indicator is perfect, so let's have a look at another one. This is the Buffett indicator. This shows the market cap of all of the publicly traded stocks relative to the US GDP. And historically, we were at around 70%. Now we are at almost 200%. So the market cap of all stocks is double as high as the GDP. Everybody says that the debt is such a problem and that the government has to spend less, which could lead to a contracting economy. Now, the absolute numbers don't really matter. What really matters is the debt to GDP ratio. And unfortunately, that's also at a historical high. Last time when it was at similar heights, we were contracting for the subsequent 35 years until 1981. Now have a look at the S&P 500 relative to US money supply. This went down until 1981. So the government had to delever, and so stocks went down relative to monetary expansion. They underperformed. What's going to happen next? Let's have a look at this relative valuation chart in a bit more detail. Again, this is the S&P 500 divided by US money supply. Historically, we are also very, very high. And last time when we were at similar heights, we just had another 2 years or so, and then we crashed down in the subsequent 10 years by more than 70%. Again, relative to how much money devalues. We don't just look at US dollar prices. Now check this out. This is the technology sector. This is technology stocks relative to USM2, again, relative to the money supply. Also at very, very similar levels to the dot-com bubble. Here are technology stocks relative to all other stocks. Also extremely close to an all-time high, higher even than we were at the dot-com bubble. Let's continue that comparison. Let's have a look at the most expensive of the tech stocks. And with expensive, I simply just mean the market cap. Let's have a look at the dot-com bubble when Cisco was the most expensive of the companies. It had a market cap of $500 million and the money supply at the time was 4.6 billion. So Cisco was worth 12% of all of the money in the US. Now in 2024, we've got Nvidia, which is worth almost 3 billion. The money supply obviously also grew in the meantime, but now Nvidia is even more worth. It's 14% of the money supply. Now this is what happened to Cisco relative to monetary expansion. It went down by 85%. I'm not saying that the same has to happen for Nvidia. I'm simply just drawing those parallels to show how high we are historically. This is not a time to get bargains. It seems like everything has already rallied, and it's actually not just the stock market, but more on this later. Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com. Everything has already rallied, everything is already up. Nvidia is not going to make another 10x from here and will be worth more than the entire money supply of the US. There will be a turnaround at some point. Now let's have a look at where we are potentially at that turnaround. Check out this chart. At the top, we've got the unemployment rate. At the bottom, we've got the S&P 500 relative to US money supply. And when the unemployment rate tends to go up, then of course the stock market tends to go down. We've seen this here in the dot-com bubble. We've seen this here during the global financial crisis, right? We start going up with the unemployment rate, the prices go down. We've also seen this in an exaggerated form artificially during COVID. What's interesting is that we are slightly creeping up in the unemployment again, but the prices, the stock market prices, have not yet come down. They are actually going up. Isn't that somewhat odd? The market seems to expect that the interest rate cuts will make a perfectly soft landing and that all of those valuations are completely justified. I'm not sure if it's rational to share that optimism. Here's another metric that's not that pretty. This is the US housing market relative to the US GDP. And again, we are at historical highs. And again, from the current level, we have seen declines of 26%. Now, 26% doesn't sound that bad, but the property market is highly levered, right? A lot of people have only 10 or 20% down on their house. So when then the prices go down by 20 or even by 30%, then a lot of people have to force sell, right? They get forced liquidated. And so is Bitcoin going to fix this? Is Bitcoin at least still cheap? One way I like to look at Bitcoin is the average cost basis, especially the average cost basis of the long-term holders. Whenever the price is currently below the average cost basis of even the long-term holders, then it's a great time to buy. Now here's that chart. We have come below the average cost basis several times in the past. So here in 2015, it had been a very good time to buy Bitcoin. Then over here after the crash of 2018, then during the COVID crash, then recently after the FTX collapse. But here's the bad news. The long-term holder average cost basis is currently at $25,000 per Bitcoin. It is slightly going up, but still we are way above that. Stock earnings seem expensive. Stock valuations seem to be expensive. Property seems to be expensive. Tech seems to be even more expensive compared to everything else. The most hyped stock of the tech market is even more expensive than Cisco was back in the days, which of course subsequently crashed. The unemployment rate is rising, but it's not yet priced in. Houses are expensive. Bitcoin is expensive. And even the dollar, relatively speaking to other currencies, isn't necessarily that cheap. This is the DXY. Now there's a saying in the Bitcoin community. Whenever we are crashing, people say, when in doubt, zoom out. The issue is that Bitcoin never existed during a real financial crisis. Bitcoin was launched over here. And yes, we did have our little hiccups with the COVID crash, but it's not comparable to .com or to the global financial crisis. Since Bitcoin's existence, the market cap relative to the GDP went up. And so maybe, just maybe, most people aren't prepared for this. Again, I'm not a crash prophet. I'm not saying that we're going to crash tomorrow or even in a year or even in 2 years. The only thing that I'm saying is that I do believe that valuations based on those pretty reliable historical metrics are very, very high. We really have to dig very, very deep to find a good deal, to find an investment that's really worth the risk. All I'm saying is that I believe it makes sense to be cautious, to try to do things that help us not get completely wiped out in case we do face harder times ahead. There's definitely a non-zero chance that we're going to see very, very hard times that are way worse compared to what we've seen during COVID. Feel free to share this video with your friends. Feel free to also give this a like. It helps the channel grow. And of course, if it's your very first time here, feel free to subscribe as well. I publish videos regularly on this channel. See you next time. Cheers.